Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, and joining me this afternoon, we have Jim Craige, co-founder, CIO, and head of emerging markets at Stone Harbor Investment Partners, and Preece, investment manager of emerging debt at Pictet Asset Management. And we're here to discuss the backdrop of emerging market debt, what regions look attractive, and where investors should have some caution. It is great to have the both of you with us. And Jim, emerging debt is a little bit nuanced for the Trade Talks audience. So give us a primer, an overview of what you look for, what factors go into the investment decisions of allocating capital to areas in emerging debt.
Sure. So the focus of emerging debt is financing companies and countries as they evolve from being emerging markets to being developed markets. So we assist in that, and in exchange for investing in these countries and companies, we receive a very high yield for that as they transition from being sub-investment grade, eventually, hopefully, all of them to investment grade.
And Craige, is there an impact of what happens in the Western world in terms of central bank policy or inflation or other measures that may have been taken? Does that impact emerging markets and debt more specifically?
Yeah, most definitely. I think, as with all fixed income markets, the setting of monetary policy in particularly the US, but also Europe and other centers of finance is key to the overall outlook. But I think one of the key features of emerging markets now is that there has been a ability to extract themselves from the sensitivity to those cycles based on expansion of access to financing from domestic financing sources, which is a key cornerstone of the development that emerging markets have seen really over the last 2 decades. And I think that that's a key feature of the investment case for this asset class.
Right. So, Chris, what is impacting the space right now more specifically?
So, I mean, front and center will obviously be the Fed. I think that we're going to see, I think we can safely say we are going to see a cutting cycle starting in the next week or so. And I think that that will be a very important catalyst for flows into the asset class. I think that, we've all seen how much money has been sitting in short-term money market instruments. And I think that a confirmation that the Fed's cutting cycle is here will lead to an extension of duration preferences in general. And I think given the attractiveness of EM fundamentals and yields, as Jim alluded to, I think that the EM fixed income will most definitely benefit from those.
Right. And Jim, what areas or what regions have you seen improvement in? Or in other words, where would you be thinking about these opportunities?
Sure. Some of the biggest disinflation stories right now are happening in Latin America and also in Africa. So these are areas that we find, again, a lot of yield being offered by companies and countries, and in places where, as Chris mentioned, you're going to have the ability to continue to cut rates in a number of these countries. So those are very strong tailwinds. When you combine the growth that we're seeing in emerging markets, particularly relative to the developed markets, those are 2 very strong tailwinds, and that's led to more upgrades and downgrades, leads to better growth, leads to better ability to service the debt, and leads to lower yields.
Right. And Chris, you had noted that mid-beta sovereigns offer some attractive opportunities as well.
Yeah, I think, to clarify what we mean by that, I think it's these countries and credits that are migrating from high yield status, so rated at BB level, that are on a path to migrate towards investment grade. And I think that there are a number of opportunities out there, namely the likes of Paraguay, Dominican Republic, maybe less clear on the credit migration, but South Africa is a transition story which fits into that bucket. And I think if we do see this soft landing scenario materialize, the spreads that are offered on some of these countries presents an attractive opportunity. But equally, if we do see growth slow down and that leads to a faster cutting cycle from the Federal Reserve, I think that will also benefit this sector of the asset class, given the improving fundamentals.
Right. And Chris, you had noted that one specific area you're looking to avoid is with Bolivia. Explain what some of the factors are relating to that.
Of course. And I think, as a general comment, there aren't that many countries that we have near-term genuine concerns about default. Bolivia is not necessarily one where we think there is a near-term risk of default. However, the balance of payments situation, there's a shortage of dollars in the country linked to a dramatic fall in the natural gas exports in Bolivia. That is leading to a consideration amongst investors as to whether or not they are going to be able to fund themselves and ultimately service the debt as coupons come due. So that's one of the countries we have concerns over. You could go into the political situation there, which is a part of the problem, but ultimately structurally it's a balance of payments issue, which is leading to increased risk of default. So that's something that we're very much focused on avoiding for the time being, but if anything changes, that will be an opportunity.
Jim, how impactful were elections on the emerging market space? I believe there were over 67 national elections this year. Of course, the U.S. is going to be in focus with our national election taking place in November. Does that lend to uncertainty when it comes to tariffs and global trade? How does that impact the space?
Absolutely, it does. And elections do have consequences. And I think the important part of what we've seen so far in emerging markets, particularly this year, and there's been a lot of elections, is they've generally been more market friendly. So the people, the individuals who've won the elections on the margin have been more market friendly. Now you always have a Venezuela in emerging markets that keeps us and Chris and I employed, but you have generally a shift more towards the right, because what's getting reinforced at the ballot box is independent central banks leading to lower inflation, better growth, better tax regimes, et cetera. And all of that has been supportive. To your point on the U.S., big election coming up this year, the uncertainty around that is certainly something that we're very focused on. And, that's something that we spend a great deal of time on as well.
Jim, in terms of trading mechanics or portfolio management, what are some of the nuances when you're looking to get into a position or out? What do the liquidity profiles look like? How challenging is it to construct an emerging market portfolio, particularly in the debt space?
Sure. In our debt space, the emerging markets are actually, the issue sizes are larger than the U.S. high yield market. So we have greater liquidity than the U.S. high yield market. In fact, we have greater liquidity than most other fixed income markets, outside of the United States. So putting on positions, taking off positions, this is an extremely liquid market. It's very large in size. The corporate market is, over $1 trillion in size. The dollar sovereign market is over $1 trillion in size. These are very large liquid markets. So putting on trades and taking them off is not difficult at all.
Right. So, Chris, in terms of positioning, what is your outlook for the remainder of the year, and how would you think to position going into 2025? Because it seems as if what's happening here in the U.S., whether we're talking about macro policy, fiscal policy, or the elections and the uncertainty that represents, are portfolios moving around that much, or is it more of a wait and see type of approach?
I think what's been interesting is that despite the sort of macro volatility, we saw in August, clearly there was a lot of volatility related to the yen and the spillover effects to global markets. What has been quite interesting is the resilience and the stability of the return stream in emerging market fixed income. And that's meant that we haven't had to change the strategy too much. And actually, what we can focus on is, where do we believe interest rates are heading at a global level? What are the differentiators within EM in terms of how we can increase the returns relative to the overall asset class through expressions in countries that we believe are on an improving path? And that's true both in the sovereign debt dollar space, but also local markets as well. As Jim alluded to, there are some attractive stories in the local space which are anchored on the disinflation path. And actually, if we see a turn in the dollar as interest rates in the US do start to come lower, I think that can really catalyze FX returns as well. So that brings the local bond component of the asset class into look for investors, and that's a very under-owned asset class. And I think that the positioning from a US investor standpoint is very light. And if we do see a turn in the dollar, I think that's where we would see the outsized returns. But we have to acknowledge the elections in the US clearly is a potential source of near-term volatility. So we don't want to run too much risk going into that, but relatively steady state overweight in general.
Right. And Jim, to wrap up here, your outlook as well.
Sure. Our outlook is similar. Now, we do think that rates are coming down in emerging markets and the local currency space. You want to be long duration across the local currency space. You also want to be overweight high yield within the emerging market sovereign debt market. We've suffered from everything from COVID to the Russia-Ukraine war to the Fed hiking rates. The biggest boost you're going to get out there is the yield that's available in the high yield sovereign space. And you want to let the yield do the heavy lifting for you. Yields of 10.5%, 11% really do a lot of heavy lifting for you. So our outlook is you're going to see continued compression in spreads. You're going to see high yield paying your way in emerging markets, and you're really getting paid a lot while you're waiting for a number of these uncertainties, which are already priced in, to evaporate and go away.
All right. Appreciate both of your insights. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.